Thank you so much for joining us. I'm Marlon Bowling with a look at our ag commodity trade here on a Tuesday. It is Crop Progress Tuesday, we like to call it. And of course, yesterday, USDA came out with their National Planting Progress numbers. And just wanted to review some of those with you, if you don't mind. On the corn planting progress, we had 7% of the nation's corn crop put in the ground as of Sunday. Well, that compares with a 9% average. We had soybeans 2% planted. The average is 1. And we had cotton coming in at 11% planted. The 5-year average there is 9. Rice way behind normal at 30% planted. The average is 43. We had spring wheat at 7% completion on the planting. They normally would have 18% in the ground, so that's a little bit concerning. We had the I-80 corridor that we call it for the corn planting. That's from Nebraska to Ohio, with Nebraska being 2% done, Iowa 2% done. Both of those are not even half of what they normally would have by now. Illinois 8% complete. They're about 3 points behind schedule. Indiana 4%. They lead the average by 1%. And Ohio hasn't really made a showing yet as of today. Now let's go to the prices. And in the corn, we've been weaker all day long. And a lot of analysts have been saying, well, you can look at the crude oil market for one thing. It's continuing to pressure the ethanol and the corn. We have May corn down 7 3/4 at 306.5, and December is down 7 1/4 now at 329 3/4. And on the soybean side, we're down 9 3/4 on the May. 816 3/4 is the last trade. November currently down 8 1/4 at 837.5. On the wheat, we start in Chicago, which is down 3 3/4 on the May, and July is currently down 4 cents right now. Kansas City is down 2 3/4 on the May and down 2 3/4 on the July as well. Meanwhile, Minneapolis wheat is currently trading 4 3/4 lower at 506, and July down a nickel. Brian Hoops joins us now, and he's with Midwest Market Solutions in Springfield, Missouri, and a lot of pressure in the entire grain complex here today. The wheat trade, talk to me about that. Why is the wheat having a hard time getting traction right now? Because earlier this week we heard there was a lot of problems around the Black Sea.
Yeah, there's still those problems in the Black Sea region, Marlon. We also maybe have some issues here in the United States. Crop condition ratings that came out yesterday showed a ratings deterioration in parts of Kansas and Oklahoma, Texas, wheat crops, Nebraska down as well. Really, it was the soft red wheat states that improved. Illinois specifically up about 8% from last week. So there's a little bit of concerns that's mounting out of that Black Sea region, with Russia putting a export limit on what they can sell out of their country. Ukraine crop was downgraded today. There's just a lot of fundamental support here from a supply standpoint for this wheat market, but with plunging oil futures, corn and soybeans, that's dragging the wheat market. It tried to rally at one point this morning, tried to rally overnight, but with these other markets kind of dragging it down, it's going to be a limiting factor for wheat. There's a lot of margin call type selling going on in these grain markets, and the fund managers balancing their portfolios out so that their ratios from what they're long, corn, soybeans, wheat, all mesh and are evenly distributed.
We're showing the winter wheat condition ratings right now, and as you mentioned, in the Southern Plains, Texas now at 58% good to excellent. That is a drop of 8 points from last week. Oklahoma down 10 points from last week to 65% good to excellent. We have Kansas down 4 points, Nebraska down 6 points. We have South Dakota declining by 12 points, but they're still Nebraska and South Dakota nearly 70% rated good to excellent. So the ratings overall still pretty good. Nationwide, the ratings went down 5 points to 57% good to excellent. We'll come back here in just a moment, and we'll analyze the latest in our livestock trade, and we'll talk more with Brian Hoops right after this. We are talking with Brian Hoops of Midwest Market Solutions in Springfield, Missouri. All right, time to talk about livestock. Well, when we talk livestock, let's talk about live cattle. All morning long, Brian, we've been pointing out the fact that we have the April live cattle limit down. It is still there. Now, it wasn't that way all day, but boy, it hasn't been trading very much. We have the June down 247 now at 82.62. I'll just stop right there. What is going on here with the cattle market to push it down like that on the nearby contracts?
Well, you've got a lot of negative news in other sectors that's driving this market down. With the stock market being down, crude oil being down as well. We did have some, light cash trade this morning at 150. The bulk of the dress trade was 155 to 168 last week. So you are seeing some cash trade that's starting to develop at quite a bit lower money. But the real burden in this cattle market, in my opinion, is the weekly slaughter. We're running estimates around 520,000 head this week, and that would be a little bit larger than last week. But as long as we're killing below 635,000 head a week, we're going to have more cattle available to kill than what we have slaughter space for, and that's just going to back up these supplies. So we would look for cash markets to be depressed here for a while until we get these slaughter facilities back up and running at full capacity.
Now, explain something. You're talking about the live cattle with the most weakness on the nearby contract. We are looking now at feeder cattle, and we have April down 162, May down $1.30, but you go way out there, and then you have October down 232. So it's just the inverse of what's going on in live cattle, where you have the most weakness in the deferred contracts. How come?
Yeah, here in the near term, the traders are mostly looking out until those longer-term contracts. You go into the August contract, that's where most of your volume and open interest is lying. That's where you're seeing most of the selling pressure starting to come in. And in the August contract, October's down sharply as well. There's concerns about we're not placing these cattle. We're going to keep them out on grass a little bit longer. That's going to put pressure against these deferred contracts as they're going to be out there on the grass pastures and eventually come to placements in the feedlots, but it's going to be sometime down the road.
All right, now let's look at our lean hogs and see what they're doing. Currently on lean hogs, you have that nearby May contract gaining $3.15. Now remember, we have these new limits to work with now that are $3.75 on the hogs. Used to be $3 like on live cattle, but now they have a little more elbow room. So the May is at $43.75, 20 cents off its high of the day. June up to 12 at $48.37, and yet you have the fall months actually a little bit weaker on the day. So the lean hogs kind of trading independently, separate from the cattle, at least for the time being here today. And it looks like they're evening up those spreads as well. Brian, thanks for the time. Good to visit with you again. Brian Hoops of Midwest Market Solutions in Springfield, Missouri, with a look at our livestock trade.